Welcome back to the channel. Today we're diving into the top investment opportunities for 2024. Whether you're a seasoned investor or just getting started, these picks are sure to help you grow your wealth. Let's get right into it. First up, let's talk about high-yield savings accounts. They might not make you rich overnight, but they're a safe and liquid option for your emergency fund or short-term savings goals. These accounts offer higher interest rates compared to traditional savings accounts, which means your money can grow faster. You're better off earning some interest than letting your money sit in a traditional savings account. High-yield savings accounts are typically offered by online banks, which have lower overhead costs and can pass those savings on to you in the form of higher interest rates. With inflation still a factor, it's important to try to outpace it, even if just by a little. By earning a higher interest rate, you can help mitigate the eroding effects of inflation on your savings. High-yield savings accounts are a solid foundation for any financial plan. They provide a secure place to store your money while still earning a return, making them an excellent choice for both new savers and seasoned investors. Next, certificates of deposit or CDs. CDs offer a fixed interest rate, but you commit your money for a set period, typically ranging from a few months to several years. The trade-off is a higher interest rate compared to a savings account, especially with rising interest rates. Just be aware of penalties for early withdrawal. Moving on to government bonds. When you buy a government bond, you're lending money to the government, and they promise to pay you back with interest. Government bonds are considered one of the safest investments, especially U.S. Treasury bonds. No investment is completely risk-free, but government bonds are close. They're worth considering for a relatively safe and stable investment. Chapter 4: S&P 500 Index Funds. If you're looking for a simple way to invest in the stock market, you can't go wrong with an S&P 500 Index Fund. These funds are designed to provide broad exposure to the U.S. stock market by mirroring the performance of the S&P 500 index. This type of fund tracks the performance of the S&P 500, an index of the 500 largest publicly traded companies in the U.S. By investing in an S&P 500 index fund, you are essentially buying a small piece of each of these companies. Historically, the S&P 500 has returned an average of around 10% per year over the long term. This makes it an attractive option for those looking to build wealth steadily over time. It's a solid long-term investment to grow your wealth. Whether you're saving for retirement, a major purchase, or simply looking to increase your financial security, an S&P 500 index fund can be a key component of your investment strategy. Chapter 5: Dividend Stock Funds. Dividends are payments companies make to their shareholders, typically quarterly. Investing in a dividend stock fund means buying a basket of dividend-paying stocks. They can provide a steady stream of passive income, especially beneficial in retirement. Look for companies with a history of consistent dividend payments and strong financials. Chapter 6: Real Estate Investment Trusts, REITs. In this chapter we will explore the fascinating world of REITs and how they can be a valuable addition to your investment strategy. REITs are companies that own and operate income-producing real estate properties. These properties can range from office buildings and shopping centers to apartment complexes and hotels. They allow you to invest in real estate without buying, managing, or financing properties yourself. This means you can benefit from real estate investments without the headaches of property management. REITs are required to distribute at least 90% of their taxable income to shareholders as dividends. This makes them an attractive option for income-seeking investors. They're a great way to add real estate exposure to your portfolio without the hassle of being a landlord. By investing in REITs, you can diversify your investments and potentially increase your returns while enjoying the convenience of a hands-off approach. Let's talk about cryptocurrency. Crypto can be risky, but it has the potential for high rewards. Bitcoin and Ethereum have already made some people a lot of money, and blockchain technology is here to stay. Only invest what you can afford to lose, and do your research. It's a volatile market, but it could be very rewarding. Next up, technology stocks. Tech stocks have been on a tear in recent years, and for good reason. Technology is everywhere and becoming more integrated into our lives. The tech sector is constantly innovating and disrupting traditional industries. If you're looking for growth potential, tech stocks are worth considering. Now, let's talk about small-cap stocks. Small-cap stocks are companies with a smaller market capitalization, typically ranging from $300 million to $2 billion. They have the potential to generate significant returns because small companies have more room to grow. Small-cap stocks can sometimes be undervalued by the market. They tend to be more volatile than large-cap stocks, so be aware of the risks. Last but not least, international mutual funds. Diversification is key, and investing internationally is a great way to diversify your portfolio. International mutual funds allow you to invest in a basket of stocks from companies outside the US. This can reduce your overall portfolio risk and give you access to fast-growing economies. Emerging markets like China, India, and Brazil are experiencing rapid economic growth, potentially leading to higher returns. Thanks for watching. If you found this video helpful, hit the like button and subscribe for more investment tips. See you in the next video.